Alright, gather round, because today we're talking about something that sounds like science fiction but is very much real, an AI designed to eliminate free money from financial markets. Yes, you heard that right. We're diving into the world of arbitrage options pricing and how a new breed of artificial intelligence, called a neural operator, is stepping in to ensure that the complex web of derivatives prices remains perfectly consistent and, crucially, arbitrage-free. It's like having a super smart, hyper-vigilant auditor for the entire options market. First, let's define our villain, or rather, our market glitch, arbitrage. In its simplest form, arbitrage is the simultaneous purchase and sale of an asset to profit from a difference in its price across different markets or forms. Think of it like this: if you could buy a widget for $5 in one store and instantly sell it for $6 in another, with zero risk and zero cost, you've just performed an arbitrage. It's literally risk-free profit, and in efficient markets, these opportunities are supposed to be fleeting, if they exist at all. In the world of options, these glitches manifest as violations of fundamental pricing relationships. One of the most famous is put-call parity. This formula states that a European call option minus a European put option should equal the current stock price minus the present value of the strike price. If this equation doesn't hold, you can construct a portfolio that guarantees a risk-free profit. It's a mathematical truth that underpins fair options pricing, and it's just one of many no arbitrage conditions that must be satisfied across the entire spectrum of options. Now, options prices are notoriously complex because they depend heavily on the market's expectation of future volatility. This expectation is captured by something called implied volatility, which is essentially the volatility figure that, when plugged into an options pricing model, yields the current market price. When you look at all the implied volatilities for options across different strike prices and different maturities, you get what's known as an implied volatility surface. This surface needs to be perfectly smooth and consistent to prevent arbitrage. And it gets even more intricate when we consider not just the S&P 500's implied volatility, often referred to as SPX implied volatility, but also the VIX. The VIX is often called the fear index because it measures the market's expectation of 30-day forward volatility of the S&P 500. So, we're talking about the volatility of volatility. When the VIX itself is highly volatile, as it can be during uncertain market periods, maintaining an arbitrage-free relationship between all these interconnected options becomes an incredibly challenging, multi-dimensional puzzle. Enter Arbiter, a risk-neutral neural operator. Now, a neural network learns to map inputs to outputs, but a neural operator takes this a step further. It learns to map functions to functions. Instead of just predicting a single price, Arbiter learns the entire implied volatility surface, ensuring it's arbitrage-free. It's like teaching an AI not just to draw a dot, but to draw an entire, perfectly smooth, mathematically consistent curve or surface, even when given only a few sparse points. A critical concept here is risk-neutral pricing. In a complete and arbitrage-free market, the price of any derivative can be expressed as the expected value of its discounted payoff under a special probability measure, known as the risk-neutral measure. This isn't the real-world probability, but a theoretical construct where all investors are indifferent to risk. It's the mathematical bedrock that allows us to price derivatives consistently and ensure that no risk-free profits can be made by simply holding a portfolio of options. Arbiter doesn't just learn to approximate the market, it's explicitly designed to enforce a battery of no arbitrage constraints. This includes static arbitrage conditions like calendar spreads, vertical spreads, and butterfly spreads, which relate options prices across different maturities and strikes. It also enforces Lipschitz bounds, ensuring the surface is smooth and doesn't have sudden, illogical jumps, and monotonicity, meaning prices behave in a logically ordered way. It's a comprehensive set of rules that prevent any free money opportunities from emerging. Imagine an implied volatility surface. Without Arbiter, it might look like a crumpled sheet, with bumps and dips that represent potential arbitrage opportunities. But with Arbiter, the surface is smoothed out, becoming a perfectly consistent, mathematically sound landscape. Every point on that surface, representing an option's implied volatility, is in perfect harmony with every other point, eliminating any chance for someone to exploit a mispricing. It's the difference between a chaotic market and one governed by rigorous mathematical principles. This technology becomes especially crucial during periods of high market volatility, like when the VIX index itself is experiencing significant swings. In such environments, the relationships between options prices can become incredibly complex and prone to temporary dislocations. Without a model like Arbiter, these volatile conditions can easily create fleeting, but exploitable, arbitrage opportunities. By continuously enforcing these no arbitrage constraints, Arbiter helps maintain market integrity and stability, even when the underlying market is in turmoil. So, what does this all mean for the future of finance? Arbiter represents a significant leap towards more stable and consistent option prices. It provides better tools for risk management, allowing financial institutions to more accurately assess and hedge their exposures. Ultimately, by ensuring that options markets are truly arbitrage-free, it contributes to more efficient and fair markets for everyone. It's a fascinating blend of advanced mathematics and cutting-edge AI, working to keep the financial system honest.